When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also answer listener questions and then finally talk about the difference between an independent advisor such as Premier Retirement and some of the big box advisors. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing?
Always good to be with you and with the listeners. It's a great day.
Well, I'm glad to hear that, Jeff. I hope our listeners are having a great weekend. We appreciate you joining us each and every week here for Premier Retirement on KNST. A lot to talk about on today's radio program, Jeff, with current events. Ray Dalio, I saw an article in which he said that what's happening could be resulting in something worse than a recession. He's talking about world conflict. Ray Dalio is a hedge fund manager, so correct me if I'm wrong, does he make money on both sides of the coin, whether things are good or bad?
I don't know if you'd say that. He's done a terrific job. He's one of the biggest, if not the biggest hedge fund manager out there, one of the most well-known, probably best performer. He seems to know credit cycles and money and the cycles, especially, that happen with money worldwide. And that just understands the game. He understands when to be in the market, when not to be in the market. He's had a lot of cautionary advice in the last few years, especially because the credit cycle is getting so overstretched, meaning that we're borrowing into this fake economy that looks good and props the market up, but isn't underpinned or supported by real growth in manufacturing here in the U.S. or jobs creation or productivity. We're just a bigger and bigger consumer. And while they print money and make the market go up, rich get richer and the poor find ways to consume more stuff. But it's really not a sustainable program. Some people like Sanders thinks that there's a way to just print money to infinity and it's not going to matter because this new modern economic theory works, but it only works so long. I mean, eventually everything has to catch up, just like the stock market. Warren Buffett very plainly stated a few weeks ago in his annual report for Berkshire Hathaway that the market can't stay out ahead of earnings indefinitely. I mean, it just keeps on going up, but the earnings are not following. And these are some of the things that, putting Trump in a really, like between a rock and a hard place when he came into office in the first place, because the rubber band's been stretched and it's ready to snap back for any reason. And you give it one like the tariffs and the market's going to be on rocky ground. And we've seen the volatility every time we think it might be having a relief rally and going up and that we're finally hitting bottom, it tanks again. And there's just massive sell-offs. And honestly, the institutions and insiders, meaning the institutional investors, hedge fund managers like Dalio and market makers themselves, like the Merrill Lynch's and the Citicorps and the Morgan Stanleys and the JP Morgans, Goldman Sachs, all those guys are net sellers, not net buyers. They're taking advantage of the frenzy and the emotion that's being created in this volatile market. But you can see the market change directions 3 or 4 times in a day sometimes. There's really no rhyme or reason to it other than some news blip that comes out. They make something of it on the news and, all these day traders and what we call tourist investors, the non-sophisticated investor that's been making money by buying the dips and just throwing money at the market because it's been a good place to make money and create wealth, just keep doing it. But the smart money's been backing off for quite a while, which is why I'm a little tentative. Obviously, there are some sectors of the market, like gold especially, is going very strong. World banks or other countries' central banks are buying it all over the world. China especially. Some governments are selling billions of dollars of Bitcoin and trading it in for gold. So obviously the price is going up. The price going from gold to 2,000 to 3,000, that's a 50% increase. 3,000 or 4,000, only a 33% increase. So it's going to be easier probably to go up every successive 1,000. And some people are calling for $10,000 gold. That kind of doesn't sound like we're having a great economy where, the dollar and stocks and all the other things that aren't gold are going to be that well supported or that bought if gold has that much attention. So that's kind of a problem area. I think we're seeing that cycle, which is typically people run to gold when there's a lot of fear. The thing is there hasn't been that fear in the market yet that has caused what we call capitulation, But when that happens, it's going to tumble. And because America is such a leader in the economic forces around the world, I think it will cause more than just a global recession. And this tariffs, unfortunately, as I mentioned a couple of weeks ago and last week, I think as well, is we got two major, big, fat-headed egos in the two most powerful countries on the planet fighting. And that's probably not a good thing. I mean, I think they're both going to end up losing something from it. But we've got probably a lot more to lose than China. And that's why they're digging in and they don't really care, because China is able to support the 3 to 5% of their population that actually exists and has a decent lifestyle. The rest of them are peons that walk to work and make a couple bucks a day and are just the worker bees that generate all the wealth for the elite of that nation. In America, we're trying to make everything equal. I mean, we even have taxes that get redistributed to those that are less fortunate and can't make it as well as the people that do. So we've got a lot more riding on this type of a recession or depression, or this global infighting that is turning into be a little bit more than maybe we bargained for, where we thought it would probably be a nice negotiating to bring everybody to the table to negotiate. And it's worked for most countries, but with another ego and the other highly rated team, which is China, it's not working out quite as well as I think Trump had planned. He thought everybody was just going to cave because he's Trump and everybody's scared of him. But guess what? China thinks they're scared of them too. And I think we have a right to be, because they really don't care about the welfare of their beings. They care about winning and being the dominant nation and basically putting the U.S. in any chance they can under their foot and squashing us. So, yeah, I think there's a lot of things that still kind of remains to be seen, worked out. I'm not a doom and gloomer. I don't like to see what I've seen, but I've also been very pessimistic about the future of the markets being so overvalued, and being that there's a lot of trade tensions and a lot of economic woes around the world that, are going to come back and affect us too. If we can fix this whole problem with tariffs and everything amicably and level the playing field with business, it will make America better and greater and stronger, and in turn make the rest of the world great. But I don't think China realizes that they want to be on the same side of two great powers that get better because everything's fair, because in their mind, they're losing by this unfair balance of trade that started back, I think, in the Nixon days, and then has intensified through more and more involvement with the free trade union and all this stuff that we're doing around the world. And we've allowed China to come in, manipulate their currency, manipulate our currency, manipulate manufacturing, manipulate everything to gain control, gain power, and to gain a lock on so many things. I mean, they're starting to turn boats around that are full of stuff that we need here in the U.S. just as a retaliatory effort, rather than say, let's figure out how we'll work this out. If you want to raise this, we're going to raise yours, but we're still going to keep sending products back and forth. We're just going to have to pay more for them until we figure out what we can pay and what's fair so that everybody wins. And I think there's a place where everybody can win. China, like I said, they've got a lot more people to support and a much taller order to fix than we do, but they also are big enough and strong enough and bully enough and I guess just mean enough that they would do everything they can to take it out on the US of A and try to squash us and make themselves be the new elite country in the country. And I think that's what they want. And honestly, I think there's a lot of countries that are jealous of the US that would love that to happen. So I think this tariff war, the fact that our credit cycles are so out of whack, that they need a correction. And typically when, markets correct from a big credit cycle, and we remember this 20, 30, I think it's been 20 plus years ago, when the pigs countries, remember Portugal, Italy, Greece, and Spain, the pigs, they call them,
right,
were, underwater with debt, and they had to remonetize the debt. And I don't remember what the number was, but it was some like 40%. So let's just say, just for example, if you had a $1,000 bond that the government owed you $1,000 when it came due, but they can only pay 40% of that, or $400, then all of a sudden your $1 million bond portfolio became worth $400,000. And they just said, okay, well, that's the way it is. Now we're not in debt anymore, or we're in less debt. So now we can exist and we can restart. Aren't you glad we're not bankrupt? And aren't you glad we can still function as a society? Well, a lot of people lost a lot of wealth, but then again, they kind of had a reset. A lot of rich people lost money. A lot of poor people probably had a chance to have a restart and actually buy securities and things that they didn't otherwise have. That may happen again here. We've got more than half the U.S. private households don't own any stock or investments and can't afford them. Maybe after a reset, maybe they will be able to, but there's going to be a lot of heartache and a lot of pain and a lot of trouble if this great reset happens. It's going to take time, and there's going to be some hurt in the meantime. And I'm just saying that to be real. That doesn't mean you have to lose money along the way, unless, of course, they remonetize all the debt and all of a sudden the bond market is worth less, which in turn takes the stock market down, which means if you're invested in stocks and bonds, and you'll probably have some sort of a value change that might work in your homes as well. It probably will be somewhat proportionate to all your neighbors and friends. And I don't know if that's a good thing or a bad thing, but That's what Ray Dalio is talking about with these credit cycles. It's something that is going to happen. It's going to feel painful, but we'll come out victorious in the end and rise from the ashes and grow again. It's not going to be over. It's just going to be hard. But guess what? Cycles are hard. Cycles happen regularly. We've been kicking the can down the road for this credit cycle way too long with QE since Obama took office. Actually, it was even before that. We had some debt created during Bush too, before that. And, a little bit here and there in prior years during some economic cycles where we needed a little bit of, money printing. But I think the debt was only in the 4 trillion range, if I remember correctly, after the dot-com bust. And now it's like 34 trillion. I mean, how did we get there? Just by printing money, just by creating an inflationary environment where the rich can get richer because high interest rates and high costs just make investments and other things go up. But the middle class and the poor class has gotten bigger and I guess, relatively speaking, poorer compared to the more wealthy or upper middle class people. So what Ray Dalio is saying, I think, is something that has happened since the dawn of time. It's happened in a lot of things that he quotes, Roman Empire, where they got too big for their britches and everything was debt and nothing was productivity. And pretty soon you couldn't get enough of the peon class to work to produce enough to create the goods and services and the things that the rich people needed. And it ended up crumbling because it got too fat and too self-absorbed and self-centered. And I think that's kind of where the wealth of America is leading us if we're not careful. So Dalio is a guy to listen to. I'll tell you, I read his stuff, and I think that's been the impetus for a lot of my comments over the last few years, just knowing what he's thinking and knowing how much caution he has going forward. Even with that caution, he's able to do things with his hedge fund when even in 2022, I think when the market crashed 20 or 30%, he was up 20 or 30. So this guy knows money. And if he's worried, I think we should all be somewhat worried and at least be mindful of what he says and make changes to your portfolio and risk tolerance, because I think if you've got a lot of risk on, you're going to be very sorry that you kept it on for the long term. I think coming into these next year or two ahead and maybe even a little bit longer, there's going to be some volatility that is going to probably make most people's stomach a little bit sick unless you're super wealthy and can ride it out.
We're talking with Jeff Logan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Talking about Ray Dalio's comments here. Something worse than a recession could be happening here if the trade wars and tariffs do continue the way they are, and particularly our relationship with China. Again, if you'd like to talk with Jeff about current events, our telephone number 520-780-9059, 520-780-9059. That's the number you'll call to get your Premier Retirement Roadmap, no cost and no obligation whatsoever. Jeff, let's continue to talk about current events. I understand that President Trump is attacking Jerome Powell, and he demands that quote-unquote loser, Fed Chair Powell, lower the rates now. Calling the Fed chair a loser? What do you think about that? That's not a very cooperating statement, it sounds like.
No, I think it's a certain way to make Powell, who probably also has an ego too, and at least some feelings, that will say, no, in your face, Trump, I'm not lowering rates. We've got inflationary pressures and we're going to keep rates high. I don't know. There's a couple of reasons why Powell shouldn't lower rates, and that is usually it's a tip-off that the economy is so bad that it needs a rate decrease so that the economy can get to speeding up again. And sometimes that's a negative sign to the market, and it creates more market turmoil, more market volatility. And the other thing is lowering rates is inflationary in the fact that if it's that much easier to get money, more and more people, especially rich people, or even the companies that really don't have earnings but have been able to borrow cheaply, can borrow cheaper again and continue to fake growth, fake earnings, and kind of fake the market out. I think it's a way for Trump to make the market happy, because I think it will look like that for a minute. I think overall the smart money would say, oh, well, if our economy is that bad, we've got to start lowering rates. Then maybe we got to start divesting a little bit. But I think most of the average Joe investor would probably think that is a great opportunity, because we've seen every time there was a rate decrease or even hints of a rate decrease in the last few years, the market's surged and gone up. Now, I think we need to lower rates because there's a big amount of pressure on refinancing the debt. If we have to refinance the debt at 6 or 7% or 4 or 5% instead of 1 or 2, like it was originally printed at, we've got a huge debt service problem that isn't going to be made up even with the crazy tariffs that we're adding to all the imports. It's going to be a big problem. So Trump needs to refinance. I can't remember if the number is $7 or $9 trillion. I've heard both numbers for some reason. 7 is the one that I hear most. $7 trillion of debt is supposed to be refinanced out of the $34 or $35 trillion that we have now to refinance. Typically is charging the government in interest maybe 1 or 2%, but those rates are going to go up to 4 or 5 when you have to, re-up those loans or re-up those bonds. The other thing is bonds, or the dollar, is becoming less and less attractive worldwide just because of the economic situation that we're in. And with the bond, it's kind of hard to print money and create that lower interest rate environment by, pressuring the price of bonds to go up. Nobody wants to overpay for a bond. They'd likely pay less for a bond because they're getting a little bit worried about this credit cycle that Ray Dalio's talking about. What if it doesn't play out and, government remonetizes debt and all of a sudden all the bonds and stuff we own in America aren't actually valued exactly like we thought they would be if they, heaven forbid, had to do something like the pigs countries did 20 or 25 years ago. And, what Dalio says may be an issue that big governments have had to do that in the past, and they have to do that again. I hope we don't. I'm betting against it. I'm hoping against it, but I'm also not dismissing smarter people than I am and what they're saying and the history that has happened before over and over again and the cycles that continue to repeat. So I'm not sure why we got here or how we got here. I do know how we got here is because all the politicians want the government and the market to look good so that not only that they can make money, but so they can get reelected by pretending the market is the economy, even though we know it isn't. Nobody wants to take ownership of the fact that we've dug a big hole, and nobody wants to be the one that grabs the first shovelful and starts throwing it in there. But eventually it's going to happen anyway. That hole's going to cave in, and we're going to have no choice but to figure out how to dig it out. And I think that's really what we're up against right now. And as much as, I was excited to see Trump get back in and get reelected after 4 years off, kind of figuring a few things out, this hole got deeper, and there's really no shoring up of the sides. I mean, this hole is getting dangerously deep, and Trump's coming in at a bad time, trying to fix things with his business acumen and skill set, yet he's never been and nobody's ever been in a situation quite like we're seeing us now with the trillions and trillions of dollars of debt and ramping up quickly, interest rates higher, markets not performing like they should, not being reflective of actual economy, and so many things that I've talked about a number of times and that we've heard from people that we've quoted a number of times. It's going to be interesting to see how we weather the storm, but guess what? Your life is decades long, right? Retirement's even decades long. This is probably just a couple years or a few years maybe that we have to ride this wave. And all bad things pass and get better eventually. And if it turns into a bad thing or even a worse than bad thing like Dalio thinks it could because Trump digs in on tariffs or because the Chinese don't want to back out or back down, negotiate or come somewhere in the middle and compromise. Instead, they want to make that hole deeper. So I am glad I'm not in politics. I wish I could just wave a magic wand and have it work the way I think it should, but nobody has that power. We elect those people we think are going to make the difference. And I hope in time that Trump's able to make that difference.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, our telephone number this morning, 520-780-9059. If our conversation has piqued your interest, call that number, get in and sit down with Jeff and talk about current events, basically anything that relates to your journey towards a confident retirement, 520-780-9059. Jeff, let's talk about gold and Bitcoin. Gold, it's over $3,400 an ounce right now. Really incredible. And Bitcoin, there is a relationship between gold and Bitcoin and other assets at the moment. Can you comment a little bit about gold, $3,400 an ounce? Does it have more room to grow even after this?
Well, I think if the economic turmoil continues, that people do look for gold as a hedge. Countries all over the world are buying it. Their central banks are buying it. I don't know what the U.S. is doing. Central bank, I know China is probably the biggest buyer of gold. They can also manipulate the price of gold by running it up to 4,000 and dumping it in our laps too and making it go back to 2,000 because they're that big of a buyer. We have to be careful and realize that gold is just although gold is now, has become more and more over the years a productive asset because it's used in electronics and a lot of other things besides just jewelry and coins that you sit in your safe. But gold does have a value, and it's very market driven by what anybody is willing to pay for it. And it's been driven up. I mean, people are less and less interested in buying government bonds, the U.S. government bonds. The dollar's shrinking. Is the value of the dollar going down a bad thing? Not necessarily. If you deal all in dollars and all the dollars are going up and down together, it's okay. But it does affect imports, goods. Other countries will manipulate their price of their currencies against ours sometimes to make ours look weak so that they can get one up on us in the trade negotiations, these trade wars. But bottom line is, as long as the dollar, and I think it still is probably the currency of choice, that's Chinese have it their way. They want the yuan to be the currency of choice in the world. And I'm sure they would love to dump all their U.S. government bonds and drive them price down into the toilet if they could. Bottom line is gold is a hedge in trying times. And I think we've still got some upside. We have a lot of buying. I'm looking at the volume on gold and all the different ETFs of gold. I went to buy a little bit more bullion a few months ago, and long before it was 3,000, thankfully. But, I remember they had to wait weeks just to get the stuff in. It was just backlogged. Everybody's trying to get it, and it's kind of hard to get. So the demand is definitely up. Supply is somewhat finite. They're still mining it. Mining companies' stocks are going better. The gold stocks, ETFs themselves are getting better. Some people are saying there's, 10,000 is kind of the limit, but I think that sounds outrageously high. I think I'd like to just see it push to 4,000 and be pretty happy about it getting there. If I'm a gold investor, if it goes back down to 3,000 and sticks around there, I think, it's still a good hedge. And I don't see it going down 50% to $1,700 an ounce anytime soon, but I could definitely see the stock market doing that. So again, it's kind of a diversification major. We've been making money in gold in our portfolios. Those people that, want to have exposure to it have done well. We've added to our aggressive portfolios, and that diversification has helped us curb some of the losses lately. And again, by and large, we're not in the market, but, we do have some longer term portfolios that do have risk on positions, and we're using gold in those positions as well. So again, I think gold still has some upside. Bitcoin is interestingly getting sold off. It keeps on trying to approach that 100 range and, can't seem to stay up around there, get sold off. And I think some of the central governments, like the central banks I was mentioning, are selling Bitcoin and buying gold instead. So I don't know how long Bitcoin's going to be one of those digital gold alternatives or not, but I know a lot of people still have it as if it's an asset worth holding. Honestly, I still can't understand it. I would day trade Bitcoin if I see volume going in, but I would be scared to hold it and expect to be able to spend it and trade it with my friends down the road. I'd rather have gold coins or silver bars or something. I think that's more of something that would hold value long term if that's what you're holding gold and Bitcoin for, is for this emergency currency. Bitcoin, I think it's still a speculative measure. That's just my take on it. I'm not alone. Warren Buffett and other smart people are in my camp, so I'm not going to feel bad about that or get embarrassed because other people are making tons of money on Bitcoin and I'm not. I'm okay not making money on Bitcoin because it's, in my mind, it's just, I don't comprehend it. If you want to get on the train and ride it and get off before it crashes or before you lose money and maybe it gets you to a place you want to go, I guess Bitcoin's a tool like anything else. But that's my take between gold and Bitcoin. If I was to choose between the two, I'd probably buy actual gold, have a little bit around the house in a safe, and buy ETFs if you want to hedge against some of the volatility in the stock market.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Been talking about current events, gold and Bitcoin. We have been talking about Trump calling Powell a loser and lower those interest rates. And also Ray Dalio fears that something worse than a recession is on tap for us if we continue the path that we're on right now, especially with China. If our conversation resonates with you, you'd like to get in and sit down and talk with Jeff Hogan about your retirement portfolio, possibly how current events in the world economy does affect your journey towards a confident retirement. Again, we're offering a no-cost, no-obligation, no-judgment retirement roadmap with Jeff. To get yours, call 520-780-9059, 520-780-9059. You can make that call this weekend. Leave your name, telephone number. Shelley will call you back during the week and set up that no-cost, no-obligation consultation with you with Jeff. 520-780-9059. And as always, you can find out more about the firm and more about Jeff online at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll be answering listener questions and talking about the difference between an independent advisor and the big box advisors when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if you have missed any part of our program today, we've had a great discussion in the first part about current events. Remember, we're a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show, many of our past shows, so you can stay on top of your journey towards confident retirement. And don't forget to call 520-780-9059. You can do it today or during the week and ask for your no-cost, no-obligation Premier Retirement Roadmap. All right, Jeff, let's get to listener questions. Our first one's Jerry listening to us in Dove Mountain. And Jerry says, I looked up my portfolio. My IRA was way up, and my personal trading account was up to 18% in one day. I think it was the biggest one-day gain ever. What do you anticipate the next few months are going to bring?
Well, I think we're going to see all kinds of ups and downs, and depending on whether or not, you could play options in the market, could have made 300% that day, probably on that one day when they announced the tariffs were going to get put on pause. And didn't really do a whole lot for China, however. I think if they put everything on pause, we would have seen a kind of a basing of the market. I think you're going to be looking at a lot of volatility until they work out things with China. I think we're going to still see some downside pressure in the stock market in general. I didn't see an age on here, so I don't know how far you are from retiring and whether or not you are in a position to take risk or have more risk. But I think there's going to be more downside ahead of us. I think there might be a little relief rally, maybe getting us back up to the mid 5,000s on the S&P perhaps. I think it's still got more downside to go, and I don't think it's out of the question to see it in the fours in the not too distant future. That's just me. I'm preparing for that. So I don't want all my assets just to be riding in the index. I think the indexes are going to be a little bit more volatile. I'd be a little bit pickier on what you pay. And I know that if you made 18% in one day, you picked a leveraged stock ETF that was either market oriented or possibly with gold and things like that. But if you're a good day trader, then keep doing what you're doing. If you like it and you make money doing that, if you're not experienced at day trading, this is a pretty scary time to try it because the market's doing all kinds of whipsaws and counterintuitive things that most day traders are learning for the first time how wicked that whole thing can be. But if you've got a personal trading account, I know how often you trade, if it's a day-to-day thing, if it's a hobby you do, or if it's just you put a trade on and check it every week or two. But it sounds to me like you're probably more of a day trader. If that's what you're doing, you're probably more savvy or more in tune with the market than most people who are still working and trying to park their money and hold and hope for the best. So again, I'm not sure I answered your question, but the next few months are probably going to bring a lot of volatility. I think the next probably year or two may also. If we have a really big sell-off, I think when we get down to that 50% sell-off range from the highs, that's a time probably where we talk about buying again. And we've had a couple of those in the 2000 and the 2008 crash. I don't think we're in such a situation that it wouldn't be very probable or highly possible to see those levels on the downside reached again. So I'd be very cautious. I wouldn't put all your money in the market until it gets to better values. I mean, I've been preaching that for a long time if you listen to the radio show. So again, risk what you can afford to lose. I wouldn't do any more than that. We might get lucky. It might keep going up. If that's the case, then the principal protected index products we use are going to take advantage of those upsides and, we're not going to miss out. But if I'm right, the market is going to correct. We're going to really be glad we're in principal protected accounts that don't go down and not having a lot of money at risk that doesn't go down either. I'd rather be the tortoise in the race and just win by being consistent and not losing than trying to change our posture, change our focus every so often and be like the hare that ends up losing the race. So that's my take on that.
Jerry, remember what goes up could go down, but you've done well. Congratulations on that. Thank you for listening to the program. Of course, we will send you out Jeff's book, Retirement, The Road Ahead. If you'd like to talk to Jeff, 520-780-9059. Okay, Jeff, let's bounce to Green Valley. And Roy writes, my wife and I are both 62. We're about 4 years away from retirement and only have about $500,000 in 401ks. She's inheriting a chunk of money, roughly $180,000. Her thought is to pay off the mortgage, about $168,000. My thought is to hire an investment counselor and invest the whole thing. What's the wisest thing to do with the money? I would like some guidance on what we should do. I need some clear thinking here.
Well, a lot of it has to do with your own peace of mind, your own value system. Some people have a 2 or 3% mortgage on their house, and I think that's a great mortgage to keep and reinvest it somewhere else. But, if you're going to put it in the market and lose it, I would have rather seen you pay that house off. If you're going to put it in a 1% CD or money market, I'd rather see you pay the house off no matter what it is. If it gives you peace of mind not to have a mortgage payment or only have to pay your insurance and your taxes, then I think that's another benefit to paying off the house. The good thing about the inheritance is that chunk of money, and I'm guessing that's not an IRA chunk of money that you'll have to pay tax on, but if it's $180,000 that's been stepped up in basis, meaning that's the net you're inheriting, then it's not like it costs you a big tax. What I am more concerned about is if you would have said, hey, I have $500,000 in my 401k, I'd like to take $180,000 out and pay my mortgage. Well, you'd have to take about $350 out to pay your mortgage off. $250 out to pay your mortgage off because there'd be a bunch of taxes to pay on that 401k withdrawal. So I'd say that was an absolute no-no. But if this is after-tax money and you don't need it for anything and you'd love to have that extra cash flow of $1,500 a month or whatever the mortgage payment is, or that principal and interest payment is, and you could dollar cost average into the market for the next 4 years between now and retirement, I think you'd have a much better chance of actually making money, because if the market does get volatile and go up and down and gyrate all over the place and whipsaw up and down for the next 4 years, your dollar cost averaging back into the market, and then you might have a nice nest egg at the end of the road rather than put the 180 now, ride it up and down in the market and end up with the market lower than it was when you started. and then still have a mortgage payment. So again, I have no problem with you paying off that mortgage with that. It makes sense to me if that makes you happy, if it fits your goals, your value system. And if all you have in savings is out of the 401k money, hopefully you have some savings in the bank other than that. But if not, pay most of it off and try to accelerate those payments so you at least don't have a mortgage going into retirement. That'll put a lot less stress on that $500,000 or whatever it ends up being in the 401k by the time you retire. I might also suggest that you take some of that profit off that 401k. If you're 4 years from retirement, there are options to guarantee you locking in a big portion of that 500,000, maybe 400 of it, into an asset that grows at a minimum of 8 or 9% a year if you use it for income in retirement. Most people want to use that 401k for income anyway. So why not move 400,000 into something that could possibly pay you $30,000 or $40,000 a year forever, regardless of whatever the market does? That plus not having a mortgage might be a perfect ticket to live comfortably on your Social Security plus whatever retirement plans you might have.
Roy, thank you so much for listening to us in Green Valley. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Again, you want to talk to Jeff, 520-780-9059. Last question this week, Jeff, comes from Nick, listening to us in Reedy Ranch. Nick says, a few years ago, I reluctantly became my 94-year-old grandmother's power of attorney after her niece passed away. My grandfather and my grandparents' children are all deceased. Soon thereafter, I learned that my grandmother had been paying monthly premiums on a $20,000 life insurance policy since 2000. Now, the premiums are $170 a month. The beneficiaries do not need the money, and after what quickly became a heated discussion, the agent advised me that canceling the policy would end any chance of a payment. This seems predatory to me. Should I stop paying the policy premium?
Well, there's a couple of questions I have on this. Obviously, this is a permanent life insurance policy because if you're 94 years old, there's no way you can get a term policy that I know of anywhere that would still allow you to pay for it. Now, the premium is now $170 a month. Has it been $170 a month for a long time? Did it just go up that way, or is it going to go up every year? I mean, $170 a month is almost $2,000 a year. If she lives 10 years, then you just basically put more money in to get $20,000 back. Is it guaranteed to be the $20,000 insurance policy? That's the death benefit. I mean, how much in there is already her premium? Is there any cash value at all? There should be. And if she's paying $170 a month, I'm guessing there might be $15,000 in cash value. If it's at zero and you're paying $170 a month, that's kind of interesting that it would be down to that level. And if the cash value is zero, then her $170 a month is probably going to go up to $200 or $300 a month in the next year or two. And then pretty soon, if she lives 5 years, you will have put your $20,000 in there. So again, insurance, depending on how you buy it, sometimes you buy it with the minimum amount of premium to get the most coverage if you die. And if you die, it gives you some benefit. If you think she's healthy and going to live 6 or 8 years, you might find out that just not paying that $170 a month and investing at some place might end up with close to $20,000 anyway. Or you might find out that they keep on raising the premium so high that you end up not affording it. She lives to 102 years old and you don't even get the $20,000 and you've paid more than $20,000 in. So I would get a schedule and see what those premiums are expected to be every year for every year she gets older, then do the math, kind of guess on life expectancy. I mean, if she just had a stroke and she's living in assisted living and expected to die in the next 6 months, definitely you keep that. That's a great investment, a return on investment, right? But if she's got years to live, then you have to decide what the opportunity cost is of using that money or saving that money. And do you really need the benefit? If you don't need the benefit, well, then don't have the benefit. If everybody's okay and you don't need that final expense, but grandma needs $170 a month to pay for her living expenses. I mean, who cares? I mean, $20,000 means nothing to your grandma. She's going to be dead. So if the $170 a month makes sense, then fine. My opinion is if the $20,000 return on investment makes sense, then have somebody that's not your grandma pay the premium because they're the ones that's going to be benefiting. So I think it's really in your hands to decide whether or not you keep it. It's doing grandma nothing. So I don't think she should be paying for it. I don't even know why she was paying for it. Somebody else should have been paying for that. And it does seem a little bit predatory why you'd sell that kind of a policy. I guess years and years ago, maybe it made sense and $20,000 would have been enough to bury her. Now it may or may not be. $170 a month seems to me would be probably a better way to live life rather than just get back when you die.
Right. Well, she bought the policy 20 years ago, so she would have been 74 when she did that. But still, there's some unanswered questions there. Nick, if you've got the policy, bring it in to us here at Premier Retirement. Jeff will take a look at it for you, and we appreciate you listening to us, and good luck with that. 520-780-9059 is our telephone number. We appreciate you listening to us in Rita Ranch, and of course, you'll get Jeff's book, Retirement: The Road Ahead. You're listening to Jeff Vogan, Premier Retirement Planning and Wealth Management, with an office right here in Tucson, also up in Mesa. If you'd like to talk to Jeff on an individual basis, no cost, no obligation, 520-780-9059 is our telephone number. Jeff, let's jump to the next topic here, and that is comparing an independent advisory firm such as yourself at Premier Retirement and some of the big box firms out there. We all know who they are. So let's start off with the topic of fiduciary responsibility. It's a little bit different with an independent advisor than a big box advisor, is it?
Well, it's a lot different. Big box advisors are basically in a box. They're told what to do and what they have to sell and basically made preset plans a lot of times. There is a little bit of flexibility when you get really to the upper echelon sometimes, I think, or at least it appears to be. But honestly, even there, I think it's a little bit more canned than you would expect from somebody that has a big box name. Independents are independents because they want to actually work for the client. You know, we work for you. We don't work for a company. Premier was formed so that we could treat your money like your money. Our mantra is, or our slogan is, it's your money. Keep it that way. It's not our money. It's your money. And we want to do the best we can with it as a fiduciary firm to put it in places that will accomplish your goals, not just the places that some company tells me I have to sell you. So there's all kinds of tools out there that you can use. Some big box companies like to only use 2 or 3 of them. And that's just the ones that they are either good at or feel that they're good at, or they make the most money doing. There's all kinds of different things. We make a different level of income on different things. And it doesn't really, that isn't what drives us. What drives us is how much you make on the level of different things. It's not a choice about us. We think we're fairly compensated for all the things that we do for our clients. We have some that are fee-based. We have some that are commission-based. Basically, a commission is nothing more than a company saying, hey, it costs us this many % to acquire a new client. If you do all our work, we'll pay you to do it. And if we say, well, shoot, we can do it for a little bit less than that and have a little bit of money left over, then it's a win-win. We benefit by helping people by using great products that, we're compensated for. But some of the big box, it really is driven by how many levels of management can get paid and how often they get paid and making money over and over again. So sometimes it just becomes a matter of the model is dictated by the profit margins or by the business model rather than by the client. And I think independents have a better chance to operate for the client and, do what's in the best client's interest. And guess what? When there's not levels of management up top, there's not ivory towers on Wall Street to pay for and Learjets and limos all over the place. We can do a lot better by being a lot more flexible and using all the tools out there in the bag and doing the best we can to strategize and to diversify a portfolio that makes sense in all the different aspects of somebody's needs, whether it be asset protection, investment growth, income from those investments, whether it be dividend, annuity income, or whatever, tax efficient payouts on everything that you own. Then what happens if you get sick? You have a long-term care plan. And what happens if you, want to leave your assets to an heir? Is it going to be done with the least amount of taxes, trouble, hassle, probate, and all those other things that I think many of the big box brokers, they say, we don't not give tax or legal advice or estate planning advice, contact somebody else. We just want to manage your money and go cha-ching, cha-ching, and see if we can make some money, and we do better when you do better, and we do better even if you don't. So it's a different model, and I'm not knocking it. I was in that model. I didn't like it because it restricted me. I felt like my hands were tied, and I wasn't able to offer my clients what I knew was out there because some of my clients would come to me with things that they'd done elsewhere, and I thought, well, that's a good thing. How come our company doesn't offer that, or how come we don't do that? And the answer was always, no, because we're good at this, and this is how you make the best long-term wealth, and blah, blah, blah. I said, well, what about protecting it for income? What about retirement planning? What about tax planning? What about how you give it to your heirs? That wasn't even part of the discussion, but I think it is a part of a discussion with somebody who's nearing retirement or in retirement. And the next big events in their life is trying to do the best they can while they're living on their assets and then passing away and leaving a legacy to who they want, how they want. So again, there's just a little bit more to it. I think in order to do it right, I just don't know how to do it without being more independent and not locked into somebody else that's dictating your business model.
So an advisor like Premier Retirement, an independent advisor, as you said, has a lot more products that they can pull from, whereas one of the big box advisors usually only have a handful of things. And of course, they're influenced by what the company wants them to sell. And many times those advisors, certainly they're advisors, but they're as much salespeople as they are anything else. So that's something to consider. Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management, difference between an independent advisor, some of the big box firms out there. I think also as a boutique firm like Premier Retirement, you aren't really just a number. I mean, Jeff, if people call Premier Retirement and they want to talk to you, the founder, I mean, they're going to be able to talk to you. They're not passed off to a junior advisor. Certainly there's not a call center.
No, there's not a call center. We have plenty of backup where we call into call centers and get things done. We have teams that work behind us that essentially are call centers that we give orders to, and they do a lot of things for us. But as far as our office, we're like a little family. There's 3 people that are always here that deal directly with the clients. And there's people in the Mesa office. There's people in our support office, which is in Topeka, Kansas. Shoot, there's probably 50 people that are at our beck and call to do things for us. But when you call us on the front line, we quarterback it. We hand it off to who can get the job done if we can't do it ourselves. And we have a big network of support staff that deals with everything from A to Z. That's why we can do so much. We appear kind of like a small boutique firm, but we're actually quite robust in the amount of business that we do and the amount of people that we're able to help.
So I think that's a very important distinguishing fact between Premier Retirement and some of the big box firms. Also, we have integrated CPA and legal services here, and we've talked before, and I'll pronounce her name correctly this time. Sometimes I call her Kirsten or Kristen, but it's actually Kirsten. She helps us out here as far as taxes go. What function does Kirsten fulfill for us here, and how do we deal with tax strategies at Premier?
Well, we have a couple of CPAs, actually. Kirsten does tax prep. She'll do the returns. She's got a little CPA practice. She used to work for a big 4 firm up in Phoenix. And then when they moved out to Dallas, her account, which was U.S. Airways, merged with American Airlines, and she decided to just stay in Mesa, not move to Dallas, and started her own practice. I gladly handed her about 150 clients that were doing taxes through our firm, and I believe weren't getting a very good job. And she started doing them and did a phenomenal job. She also understands the type of planning we do and that it's okay to sometimes do a Roth conversion and pay more taxes now so we don't have to pay taxes later. It's easy to get along with somebody that you've actually kind of trained up in the way we plan that can do tax returns and not get surprised or jarred by some of the things that we do that have to do with tax planning that may change the typical tax structure that a lot of the enrolled agents at H&R Block or some of the CPAs that really are just focused on tax returns and getting every deduction you can, but not really doing a lot of planning for the future. She gets that. She gets the planning part. And, she's very supportive in that. Now, as far as additional tax planning, Taylor, my son's a CPA. He does have an outside gig that he's finishing up and will eventually retire from, but he's got one foot in the business so far and is able to help us with certain tax planning stuff. He's also a CPA, worked for a big 4 firm in Phoenix, and then graduated out of that into more of the private practice, but he's gradually moving his way into the practice here. We also have super high level advanced estate and tax planning for people that have actually managed family businesses and family banks, people that have worked for the top levels of advisory services in what we call advanced tax planning, working with billionaires and structuring huge plans between charities, estate planning, trusts, and different things as well. When there's things that are a little bit higher level, and it's on more of an occasion, not a daily basis, when somebody that's selling $100 million worth of real estate needs to reposition it and have a tax plan, that we have to rely on some of these higher level people. But it does happen, and we do have those resources when it does. So we can tackle tax questions. We can tackle tax returns. We also have the resources to refer us to experts in all those fields when those that work with us on a day-to-day basis aren't able to probably go that distance and help somebody to certain levels.
Jeff, because you're not dealing with corporate red tape when something happens, changes in the market, are you able to pivot more quickly than one of the big box firms could possibly do?
Well, I think so. Even when it comes to our financial management, I mean, we can rebalance a portfolio every day if we see market moves and things like that from the standpoint of even portfolio management. But most corporations really just kind of hold and let that portfolio sit, don't do active management. We have regular visits where we kind of bite off a retirement plan year to year. But if people want to visit more often than that, we can do things as quick as somebody wants to, because we do work hand in hand, face to face and in person with most of these people. Well, probably 99% of our clients. Some of them do Zooms because they don't come to Arizona anymore. Maybe they're from out of state and they used to, but they don't, or just because they're out of town on a trip. I had a conversation with somebody. I was in Australia not too long ago. I don't care where they are. If they have a question, we need to update or do something or move some assets, we can do that no matter where you are. Phone call and text work just fine. Emails work fine around the world. So I think we are very attentive and pretty nimble. I believe that we do a pretty good job of responding. And if we don't, just ask the question again. Maybe we didn't understand it, but I think we're on top of the ball. And I think that's why we keep so many clients. We don't have very much in the way of turnover. We're way under industry standards. So most of our clients leave because they pass away, and not because they don't like what we do.
Right. And I think, as you just touched on there, we have a concentration on long-term relationships here at Premier Retirement. You're not just a number.
Yeah, we kind of call it the Premier family. When we acquire a new client, we say, well, welcome to the Premier family. And we want you to feel like that. We want you to feel like there's nothing you can't say or ask. And again, we'll treat you like family. We like the close-knit function we provide here. We're not like a big box. We're not trying to get the biggest numbers. I'm not trying to build a company that I can sell off for $100 million and retire and make a big bank. I just want to help a lot of people. I like doing what I do. So I'm still doing it. My kids are following the same footsteps. My boys, they like doing this type of work. And I think they're going to carry it on for another generation or so, another few decades. But, we don't treat people like a number. We realize they're humans, and we realize that they have needs, and we realize that their needs might be different from one to the next. And we try to listen and understand those and make those changes and adjustments accordingly.
So if you're someone who values custom advice, transparency, a little deeper advisor relationship, going with an independent firm such as Premier Retirement can really be a smarter long-term move, especially when you're preparing for retirement. So if you'd like to vet us here at Premier Retirement, you've got some questions. Again, no cost, no obligation for that. 520-780-9059 is our telephone number. We'd love to hear from you what your questions, your concerns are. 520-780-9059. You can call that number this weekend if you want. Request your Premier Retirement Roadmap, no cost and no obligation whatsoever. 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment for you. You can also find out more about us online at primret.com. Jeff, out of time for this week. Thank you so much for your time. But most importantly, as always, every week I want to thank our fine listeners for joining us. So for Jeff Vogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.